What is underemployment? Understanding financial instability. Imagine working hard every day but feeling like your job doesn't match your skills or your hours are not enough to pay the bills. That's what underemployment is all about. It's a situation where someone is employed but not in a way that fully uses their abilities or desired work hours. And like unemployment, where a person has no job and is looking for one, underemployment means being employed but still feeling the pinch. It includes workers who are overqualified for their jobs, those working part-time but wanting full-time hours, and people whose hours are fewer than they prefer. Sometimes, it's called hidden unemployment because these workers are counted as employed but are not fully engaged or productive due to economic or seasonal reasons. In the United States, underemployment is measured as the percentage of employed people working fewer hours than they want or in jobs that don't match their skills. When the economy slows down, underemployment tends to go up, and during times of growth, it usually drops. For example, during the recession years like the Great Recession and the COVID-19 pandemic, underemployment rates jumped significantly. As the economy recovered, these rates gradually declined. The main causes of underemployment are economic downturns, which reduce demand for labor, and structural changes like new technology or shifts in industries. Employers might limit hours to save costs or avoid providing benefits like health insurance. Younger workers and recent graduates tend to face higher underemployment rates compared to older workers. Financial instability happens because underemployed workers often earn less than they would in full-time or properly matched jobs. Part-time workers usually get paid less per hour than full-time workers, and overqualified workers might accept lower wages than their skills deserve. This can make it harder to meet living expenses, save money, or plan for the future. It also limits access to benefits like health insurance or retirement plans, which are often tied to full-time work. Looking at different groups in the United States, underemployment hits some populations harder. Young adults, minorities, and recent graduates are more likely to experience it. This can widen economic gaps and make it harder for these groups to build long-term financial stability. Understanding underemployment helps policymakers see the full picture of the labor market, beyond just the unemployment rate. Fixing it might involve creating more full-time jobs, improving job training programs, and making labor policies that reduce precarious work. In simple terms, underemployment shows us that many workers are not fully utilizing their skills or working enough hours, which can cause financial stress and affect their long-term economic health. It's a hidden challenge that affects many people and needs attention to build a stronger, fairer job market.